U.S. non-farm payrolls surged by 172,000 in May, far exceeding the median economist estimate of 85,000. This has completely crushed near-term rate cut expectations, supporting a stronger dollar and weighing on global risk asset valuations. This is geopolitics and economy. This video reflects only personal views and does not constitute any investment advice. Markets have risks. Invest carefully. Global asset pricing is undergoing a dramatic reconfiguration. First, let's look at the United States. The May jobs report smashed expectations. It not only pushed long-end Treasury yields higher, but also put immense inflation-fighting pressure on incoming Fed Chair Kevin Warsh. Markets are even pricing in tail risk of a December rate hike. This strong employment data has completely debunked the recession narrative of a rapidly cooling labor market and provided fresh support for a strong dollar. Second, tech stocks suffered a deep Netscape-era sell-off. Dragged down by disappointing AI guidance from Broadcom and Micron, the Nasdaq tumbled 1.4%. Capital is frantically fleeing overvalued AI hardware and semiconductor sectors. Markets fear that nearly $1 trillion in annual hyperscale capex won't translate into equivalent software cash flows. This stampede out of crowded positions has quickly spread globally, marking a shift in asset pricing logic. Third, former President Trump plans to impose a 15% global tariff under the Trade Act of 1974. He announced on social media that he intends to invoke the act to immediately raise the baseline global tariff from 10 to 15%. This would bypass lengthy congressional legislation, directly creating tariff barriers against global supply chains. This move has triggered defensive hoarding of commodities like COMEX copper in North America, fueling medium to long-term imported inflation expectations. In other words, this policy shift will have a profound impact on global trade patterns and inflation expectations. Finally, the SEC has proposed reducing earnings report frequency from quarterly to semi-annual. The Investor Advisory Committee is reviewing this major regulatory proposal. Academic research and market voices warn this will significantly increase information asymmetry, push up trading costs, and reduce market liquidity. It could raise the cost of capital for listed companies and trigger strong protests from retail investors. Indeed, this will reshape the micro-liquidity structure of U.S. stock markets, posing greater challenges for retail investors' decisions. Next, we focus on the Chinese market. First, the May Caixin PMIs both expanded, with the divergence between manufacturing and services narrowing. The manufacturing PMI came in at 52.2, and the services PMI at 52.6. The composite PMI, driven by new orders and projects, hit a 3-month high, showing domestic macroeconomic momentum is still in a recovery track. However, with global freight surging and commodities volatile at high levels, companies face severe pressure from rising fuel, wages, and raw material costs. Profit margin recovery is significantly slower than the pace of expansion, and uneven domestic demand still constrains corporate capex appetite. Second, the People's Bank of China unexpectedly conducted 500 billion yuan in outright reverse repos. The move aims to maintain ample liquidity in the banking system, hedging against the transmission of overseas tightening expectations and exchange rate volatility risks. The central bank conducted 500 billion yuan in 3-month outright reverse repos at a fixed volume and auction-based rate. This precisely injected long-term, cross-quarter funds, reinforcing a moderately accommodative policy foundation and showcasing the independence and resolve of China's monetary policy amid the Fed's high-rate environment. Third, A-shares hit a record 3.1 trillion yuan in volume, with AI, optical module, and semiconductor names suffering a stampede. Total turnover across Shanghai, Shenzhen, and Beijing exceeded a staggering 3.1 trillion yuan, an all-time record. The Chi-Next and STAR indices led declines, with Chi-Next plunging 3.2% and breaching the key 4,000-point mark. The market showed extreme divergence with weak indices but strong individual stocks, as foreign and quantitative capital concentrated on smashing high-flying tech names. This highlights a brutal microstructure cleansing in the overcrowded AI hardware track. Finally, a tense standoff occurred between maritime patrol vessels from both sides of the strait near the Dongsha Islands. China Coast Guard Ship 3501 and the Taiwan Coast Guard Vessel Patrol 9 engaged in their second intense confrontation in a month in restricted waters near the Dongsha Islands. Beijing is accelerating routine law enforcement patrols and power projection around the South China Sea and Taiwan Strait. Against an already fragile global supply chain, this further raises geopolitical risk premiums and shipping insurance costs for this critical waterway. Next, we turn to the Middle East and deep shifts in energy markets. First, Oman's Mina Al-Fahal port was hit by a drone strike, halting crude loading. Oman's key Mina Al-Fahal port experienced a suspected drone attack and violent explosions near its single-point mooring 1 and 2 berths. This forced the suspension of loading operations for multiple supertankers for several days. This incident marks an escalation of regional conflicts spilling over to peripheral safe ports and critical energy infrastructure around Iran. The risk of shipping disruption in the Strait of Hormuz has skyrocketed, touching the rawest nerve in global oil markets. Second, the UAE officially left OPEC+, fracturing the producer alliance's foundation. Aiming to break free from long-standing quota constraints and pursue a profit-maximizing independent oil strategy, the UAE's withdrawal from OPEC+ took effect. The remaining 7 core OPEC+ members, in an emergency online meeting, announced a production increase of 188,000 barrels per day for June. But their official statement deliberately stayed silent on the UAE's departure. Because the UAE held the group's only remaining substantial, rapidly deployable spare capacity. Its exit leaves OPEC with almost zero buffer against geopolitical supply disruptions, pushing the oil market's anti-fragility to a historic low. This means any minor geopolitical friction could directly translate into violent oil price spikes. In my view, this will completely strip the global oil pricing system of its safety cushion. Finally, Russian President Putin delivered a major speech at the annual St. Petersburg International Economic Forum. He stated that Western unilateral sanctions freezing Russian sovereign assets abroad have irreversibly destroyed the credit foundation of the dollar and the euro. This has triggered deep global reflection on the safety of reserve assets. Putin downplayed signs of a Russian economic slowdown, emphasizing Russia's macro debt ratio is far lower than the West's, and that is cooling the economy proactively to control inflation. He implied Russia is fully adapted to and prepared to maintain its current wartime economy and financial decoupling model long-term. This stance further intensifies the de-dollarization trend and bloc confrontation in the global financial system. In the Asia-Pacific, markets also face severe challenges. First, South Korea's Kospi index collapsed 5.5%, with memory chip giants losing massive market value. Hit by the shock from Broadcom's guidance miss in the US, the Korean stock market, heavily reliant on the AI memory cycle, especially HBM, suffered a black swan sell-off. The Kospi plunged 5.5% in a single day. SK Hynix tumbled 9.9%, and Samsung Electronics fell 6.4%. Extreme panic over a potential AI computing capex bubble directly punctured the valuation narrative for the semiconductor supply chain, triggering a foreign capital exodus. Second, South Korea's central bank completely abandoned rate cut expectations, with the won approaching the critical 1,530 level. Facing strong Q1 GDP growth and resurgent inflation pressure, the Bank of Korea has fully turned hawkish. Markets are aggressively pricing in 50 basis points of rate hikes by year-end. Combined with stock market capital outflows, the $1 exchange rate broke below the 1,530 mark, forcing South Korean foreign exchange authorities to build stronger defensive intervention barriers. The South Korean economy is under severe stress from both financial leverage and the export cycle. In my view, this signals that South Korea's macroeconomic policy space is narrowing sharply. Third, Japanese real wages rose for the fourth consecutive month, paving the way for a BOJ rate hike. Official Japanese data showed the longest stretch of real wage gains in 4 years, with positive growth for 4 months straight. This key macro data has fully solidified the logic of a virtuous wage inflation cycle, providing the most solid ammunition for the Bank of Japan to formally raise its benchmark rate at the June monetary policy meeting. Impacted by this and the U.S. semiconductor sell-off, the Nikkei 225 closed down 1.3%, with chip equipment giant Tokyo Electron plunging 6.6%. This shows the Japanese market, while facing a macroeconomic policy shift, has also not been spared from the global tech stock adjustment wave. In this complex global environment, which companies stand to benefit or lose? In my view, CATL is worth watching. Its thesis is a long-term structural trend. The company's newly approved core patent for battery packs and power devices significantly optimizes capacity ratios and structural costs under different voltage platforms. R&D spending remains high, with global oil prices holding above $90, raising the cost of fuel vehicles. CATL's extreme cost-cutting ability will accelerate the shift from oil to electricity. Even facing a potential 15% U.S. tariff barrier, its moat built through technological advantages and overseas factories still gives it strong pricing power. Long-term core earnings expectations are steadily upward. Next is COSCO Shipping Holdings. Its thesis is also a long-term structural trend. The attack on Oman's Mina Al-Fahal port and the normalization of regional geopolitical turmoil mean the Suez Canal and Red Sea reopening remains far off. At the same time, North American importers are massively pre-ordering and stockpiling to hedge against Trump's 15% global tariff threat. This has led to extreme tightness on trans-Pacific routes. The combination of constrained supply and panic demand will sustain an irrational boom in container freight rates for the next 6 months, directly driving a major earnings beat for the company. As for the losers, in my view, Air China is worth watching. Its thesis is a long-term structural trend. It is a classic victim of the high oil price and weak currency macro double whammy. WTI crude hovering above $93 significantly pushes up jet fuel costs. At the same time, the strong dollar environment from the jobs beat and RMB depreciation pressure cause severe forex losses on its large dollar-denominated aircraft leasing liabilities. High operating costs cannot be fully passed on to budget-conscious travelers via ticket prices, making profit pressure structurally medium to long-term. Next is Zhongji Inolite. Its thesis is short-term event-driven. It saw a massive 27.5 billion yuan in daily trading volume, with net institutional capital outflow among the highest. Combined with a huge lockup expiry of low-priced restricted shares, profit-taking pressure is enormous. Amid the global systemic risk of AI hardware valuations being slashed following Broadcom's guidance miss, even if its 1.6T optical module fundamentals are intact, it will still face a brutal technical breakdown in the short term due to liquidity draining and microstructure deterioration, entering a painful valuation digestion period. Finally, let's dive into 4 major long-term thematic signals. First, the black hole effect of computing capex has reached a tipping point. The global semiconductor sell-off triggered by Broadcom shows that market tolerance for endless AI hardware spending is exhausted. The investment logic is shifting from a blind computing arms race to a brutal phase demanding killer applications and cash flow conversion. This means future investment in AI hardware will place more emphasis on real-world applications and profitability. Second, the global oil pricing system has completely lost its safety cushion. The UAE's definitive departure from OPEC Plus means the valve controlling the world's last spare production capacity has been removed. Any minor geopolitical friction in the future will directly and proportionally translate into violent oil price spikes without any buffer. In my view, this will significantly increase energy market volatility, with knock-on effects on the global economy. Third, a commodity front-running and hoarding cycle driven by high tariff barriers has begun. The U.S. directly invoking the Trade Act of 1974 and threatening a 15% global tariff has completely disrupted normal international trade flows. This has led core industrial resources like copper and shipping capacity to be deeply hijacked by panic buying's financial attributes, detached from actual supply and demand. This systematically raises global manufacturing costs. In other words, global trade patterns are undergoing profound changes, demanding more from supply chains and cost control. Finally, changes to the U.S. stock market regulatory framework are reshaping micro-liquidity structure. The SEC's proposal to shift listed company earnings reports from quarterly to semi-annual suggests a potential regression in U.S. market information transparency. Increased information asymmetry will permanently raise retail trading costs, and a repricing of liquidity premiums will trigger long-term, hidden market instability. Indeed, this means retail investors will face greater information disadvantages and trading risks.